So in total, there's 147 stocks under our coverage. Taking your feedback, we've made a few new enhancements this time around just to make it easier to identify where the opportunities are, what some of the stocks to watch are. We've included a big green sticker, which you can see there on the slide. So if you go through the playbook, the stocks that the analysts have called out as a result to watch, you'll notice a big sticker there just identifying that. The other thing, we've included an investment thesis on that stock, so a very short, succinct view around sort of why we like it or why perhaps there's some risks around that particular name. So just taking on your feedback, making it easy to digest and make it really tangible for your clients. As usual, we've got 3 to 4 key focus areas in each one of those company previews. And importantly, we've got a consensus table, so where we sit if it's relevant for that particular stock. We've also released a reporting season calendar. So those of you who are new to it, there's a calendar there with clickable links through to each one of those stocks that we've previewed who are reporting in August. So just very easy to sort of see where you're at, click through and find out what the analyst is thinking for that particular stock. Also a sales point template as well, I should note. So as usual, Tom and I just cover the high-level themes, what we expect to see during reporting season, so we'll touch on those shortly. The analysts have also identified 14 large cap stocks and also 31 small cap stocks that are expected to either beat or miss expectations. So quite a number there. I think it's really interesting this time around that we've got almost an equal weight of hits as well as misses this reporting season. So a good spread there. And I think it's a great reminder to everyone that avoiding the pitfalls, the potholes this reporting season will be just as important as getting the winners right. So it's important you have a look at those, and particularly those stocks where the analysts have called out some risks over the result. Moving on to the macro, I'll just touch on a few themes and then I'll throw it over to Tom. Well, as we move through to this reporting season, macro takes a bit of a backseat. We know that interest rates are stabilising, inflation's come down, so thankfully macro is taking a bit of a backseat. And what we've seen, the correlation across the market has in fact fallen, as we've talked about all year. You know, there was a time there where it sort of rose again, but we are seeing correlations across the ASX 200 continue to fall. So it's telling us there's a greater divergence between the winners and losers in the market. And we think the markets, focus on the fundamentals is a really sensible one, particularly in the backdrop of the economic climate which we're moving in, where it's a lot harder now to get earnings growth. We've got higher inflation, as we know, and economic conditions are a little bit more challenging. So if you look at some of the factors that have performed over the last 30 days, they are profitability factors. So things like ROE, margins, ROA, for instance, that should be ROE and ROA, but have been the key factors that have really outperformed over the last 30 days. Whereas you look at what's underperformed, well, it's leverage and it's EPS growth. So, those things that the market really has taken for granted over the last few years in a low interest rate environment are coming back into focus now. So I do think the focus by the market is a good one. So again, why it's important to just pay close attention to how the profitability of your companies are looking, particularly in your portfolio, rather than just chasing pure growth. Meanwhile, when we're looking at valuations as well, we're coming into this reporting season with valuations really rebasing. If you look at the ASX 200 industrials valuation, it has come back down significantly, so it has derated, and it has really found a base over the last 12 months to about 16.6 times, which is slightly above average, but nonetheless, what we have seen is enormous rebasing of the valuation. So I think it bodes well for the valuation. I don't think we see that huge valuation reset in either direction. I think really it's down to what the E will do in the PE ratio. That's really going to drive performance from here, not so much valuation movements there. So as we previewed last week, and as I talked about last week, we do expect some continued earnings erosion through reporting season. We don't think earnings are going to fall off a cliff. But nonetheless, we do think we will continue to see earnings expectations revised down. So some of the names that we've called out in the playbook, and as well as on the front page, Ancor, ARB, APA, JB Hi-Fi, Transurban, Treasury, Costner and Iris, just to name a few that were caught out at risk heading into this reporting season. So while we do think expectations will be reset, so we continue to see that erosion of earnings, we're unlikely to see that big earnings rebasing. I think that the market's looking for that big reset that incorporates, I guess, what the economic climate's going to look like in 12 months rather than what it feels like now. So, and if the last few years have been a bit of a guide for us, we're not going to see much in the way of quantitative guidance moving forward. We've typically, coming out of a reporting season, particularly post-COVID, has only seen 20%, so 1 in 5 companies really provide that quantitative guidance moving forward. So again, we expect forecasts for FY24 to remain quite conservative, and therefore we don't see a significant downward revision in EPS for 24 numbers this reporting season. Other themes that we're watching, a big theme has been rising interest rates. And if you can see the chart on your left-hand side gives you an idea of the borrowing costs, of the changing borrowing costs for companies over the past year. So over the last 12 months, or just less than 12 months, we've seen a 3.8% percentage point delta between what companies were borrowing at the start. That was, close to May last year, through to now at the end of May, it was 5.2%. So we've seen a rapid rise in interest rates. So we haven't seen that before. Normally it's a lot steady. Everyone has time to prepare for it. So it is catching both the market as well as companies a little bit off guard. So what we have done in the report is have a look at the sensitivity to interest rates. So all the analysts have gone through their coverage universe and really called out names that we think may be susceptible to rising rates, particularly where they haven't fixed interest rates. And we've called out where we know companies have the proportion of fixed to variable interest rates. So we think rising interest costs will be a theme. A lot of companies have already been talking about it. We've seen the likes of some of the REITs, Collins Food, Orica, GrainCorp call out in some of their recent results and updates. So it is going to be a theme this reporting season. Other notable themes around small caps, we've talked about this before, but the underperformance of small caps, we've heard this quite a bit from a few fund managers as well now, but that continues to underperform. So we do think this reporting season, the focus will be on some of these names just to ensure trading continues to hold up, and particularly some of those names that we've called out as key results to watch as well, we'll be looking out for. So while we don't think, this reporting season is going to be that catalyst for small caps, nonetheless, we are looking at small caps and just for confirmation that things haven't deteriorated nearly as much as what the market's perhaps pricing in for some of these small caps. So we are looking for them to rebound at some stage. We should note, since we published the report in June, the names that the analysts have called out as key small cap names to watch have been up on average around 8%. So there is a little bit of movement there in some of those small cap names. So worth having a look at, and we've reiterated some of those names in the report as well. The other notable theme, I guess, is around short interest. I guess it's notable this time around that even though the market's actually held up quite well, we've seen short interest and days to cover actually fall back. So I think that negative sentiment going into this reporting season is quite interesting, that short sellers are increasing their positions at an overall market level going into these results. So perhaps some of that pessimism is coming out of the market. But that being said, there is a bit of concentration in some sectors and some specific names. So we called those out in the report. So specifically around some of the high growth names, and some of the cyclicals, so as well as some of the lithium names have been sort of targeted by short sellers. So continue to see weakness, I guess, around some of the growth names that perhaps have outperformed recently. Some of the cyclicals like Domino's, Breville, ARB, Boral and Downer. So just concerns perhaps around some of the building material construction side of things, and some of that weakness in cyclicality. But with that, I might turn you over to Tom, who's got a few other notable themes that he's going to call out.
Yeah, thanks, Tangi. Good morning, everyone. Just a couple of very quick observations that I found interesting through this work was around those earnings trends, which Tangi mentioned that we have seen an erosion in expectations both in FY23 and next year's earnings. But as Tangi alluded to around there being a margin of safety in those expectations, I just wanted to note that downgrades to FY24 numbers have been quite narrow. And if you exclude sort of the revisions in the banks and healthcare names, there actually has been a pretty flat revision to FY24 numbers. And in fact, there's been several sectors that have seen EPS aggregate upgrades for FY24 across sectors like IT and software, industrials, transport, gaming, housing, and insurance. There's some pretty cyclically exposed sectors in there that have actually seen some small net upgrades. So quite comfortable that there are, as we said, a strong margin of safety built into those numbers, although we wouldn't be surprised to see some of those numbers come back a bit through reporting season. Now, if you look at where that growth rate is, 24 profit growth for industrials only is a bit below 6%. Now, that's not bad at all. It's actually in line with the long-term average growth rate for industrial profits in Australia over a long period of time. It just isn't as compelling as it has been in this post-COVID era of 10-15% profit growth and recovery from those pandemic-affected years. So not too concerned yet about earnings falling off a cliff as the market sometimes wants to believe. Just in commodities and resources, huge part of the market, obviously. We've updated our sort of strategy overall there, talking about China and what we think might unfold over the balance of 23. Just looking at commodities and industrials as well around dividends, we're expecting another really strong dividend season. I think we do conclude, though, that perhaps dividends won't be as high as hoped, particularly in commodities where Adrian's calling out, cost inflation pressures, yes, to slow, but to not revert or reverse. We're also detecting a tone amongst our resources coverage that management teams have more excuses to hold and retain more cash. There's lots of reasons for that in commodities, but I do think that dividends have scope to underwhelm as perhaps EPS underwhelms in commodities. And we do actually call out, all of BHP, Rio, FMG, Woodside, along with a couple of industrials names that might underwhelm on dividends versus hopes and expectations overall. So do have a look at those sections in the report for those nuances in some of those themes that Tangi touched on. Thank you.